Welcome to the deep dive. You know I love a good deep dive, and today we're taking a look at The Simple Path to Wealth by J.L. Collins. And you guys have been kind enough to share the front matter, the dedication, the disclaimer, the acknowledgments, and the foreword. And I gotta say, I'm intrigued already. What kind of jumped out at you from these early peaks?
It's interesting, right? You mentioned the dedication to his daughter. I think that really sets the tone for the whole book, you
Yeah.
know? It feels like advice from like a caring mentor, not just another finance guru. What really struck me though was the disclaimer.
Oh, yeah, where he begs people not to sue him for their own investment decisions.
Right.
Hilarious, but insightful too, right?
Exactly. It speaks to a key point I think that Collins makes throughout the book,
Hmm.
which is taking responsibility for your own financial journey. He's giving you the tools and the knowledge, but ultimately the choices are yours.
Okay, so responsibility is a big theme. So let's dive into the meat of the introduction here. Collins lays out his core philosophy. Spend less than you earn, invest the surplus, and avoid debt. Pretty straightforward, right? But how often do we actually follow those seemingly simple rules?
That's the challenge, isn't it? Like, we know what we should do, but putting it into practice is a whole other story. It's like knowing you should eat healthy and exercise, but then reaching for the chips and binge watching TV instead. There's a gap between knowledge and action.
Oh, I feel that. So how does Collins bridge that gap? Does he offer any practical tips for actually implementing these core principles? Or is it more about the mindset shift?
It's kind of both, and I think that's what makes his approach so effective. He talks about the psychology of spending, how we're bombarded with messages that encourage us to buy things we don't need. And he really encourages readers to be mindful of their spending habits, to focus on what truly brings them joy.
It's like Marie Kondo, but for your finances, like decluttering your spending and keeping only what sparks joy. I love that. But what about debt? He compares it to being covered in leeches. That's a pretty intense visual.
It is, but it's effective, right? Debt can feel suffocating, like those leeches are constantly draining you. And Collins really hammers home the importance of breaking free from that cycle. And he doesn't just say get out of debt. He provides strategies for doing so.
Okay, so we've got practical advice check, but let's move on to something that really grabbed my attention. FU money. It sounds a bit rebellious, but there's a powerful idea behind it, right?
Absolutely. It's not just about being rich. It's about the freedom that comes with financial independence. It's the ability to walk away from a job you hate, start your own business, travel the world, or simply to have peace of mind knowing you're financially secure. What would FU money enable you to do differently?
That's such a great question for our listener to ponder. For me, it would be the ability to pursue creative projects without worrying about making a profit. But FU money implies having a significant amount of wealth. Is that really attainable for the average person?
That's where Collins' emphasis on saving and investing comes in. He argues that anyone can achieve financial freedom, even on like a modest income, by adopting the right habits and sticking to them over time. He makes a compelling case that even saving 50% of your income is possible.
Wow, 50%. That's a bold statement. But before we dive into his saving and investing strategies, let's talk about the acknowledgments section. I mean, an editor fleeing to a monastery, a cover illustrator arrested for grave digging. These stories are wild. What was your take on that?
I love that you brought that up. It goes beyond just funny anecdotes. It shows how many different perspectives contributed to this book, from financial experts to artists. It reminds us that achieving financial freedom is a journey, and it often takes a village.
Okay, so we've got responsibility, practical advice, freedom, and a supportive community. Now let's move on to the foreword by Mr. Money Mustache, a figure who embodies financial independence. He praises Collins' simple approach, highlighting that you can be successful with just one Vanguard fund. That's quite a statement.
It is, and it sets the stage for a key concept we'll explore later: index funds. Mr. Money Mustache is known for his frugal lifestyle and savvy investing, and his endorsement lends a lot of credibility to Collins' approach.
So, simple principles, index funds, and a long-term perspective. Seems like a solid foundation so far. But before we get into the nitty-gritty of investing, there's one big elephant in the room: market volatility. How does Collins suggest we handle those inevitable ups and downs, especially when everyone else is panicking?
That's where his advice gets really interesting, and it's something we'll explore more in depth in the next part of our deep dive. He encourages a counterintuitive approach. Buy more shares when the market dips, even though it feels scary. Think about your own reactions to market fluctuations. Do you tend to panic and sell? Or do you see it as an opportunity?
That's a great question for our listener to consider. I know I've been guilty of emotional investing in the past, But Collins's approach seems to require a lot of discipline and a strong belief in the long-term resilience of the market.
Exactly. It's about shifting your mindset from fear to opportunity, which is easier said than done. But we'll unpack that more in part two. For now, we've laid the groundwork with Collins's core principles, the importance of responsibility and long-term thinking,
Mm.
and a taste of what's to come.
Welcome back to our deep dive into the simple path to wealth. We left off talking about market volatility, and I'm eager to hear more about Colin's advice for handling those inevitable dips. He suggests buying more when the market drops, which seems kind of counterintuitive. Can you explain the logic behind that?
It's all about taking advantage of the sale, just like you would with any other purchase. When stock prices go down, you're essentially getting more for your money. Collins believes that over the long term, the market tends to go up. So buying low allows you to maximize your returns when the market eventually recovers.
That makes sense. But it still requires a lot of faith in the system, especially when you see your portfolio shrinking. It's easy to let fear take over and sell everything, thinking you're cutting your losses.
Absolutely. Our natural instinct is to avoid pain. And seeing our investments lose value can trigger a strong emotional response.
Yeah.
But Collins argues that selling during a downturn is like locking in those losses. It's about resisting that urge and staying focused on the long-term growth potential of the market.
So it's about having a plan and sticking to it, even when it feels uncomfortable. Speaking of plans, we briefly touched on Colin's love for index funds in part one. Can you explain what they are and why he's such a big proponent of this approach?
Imagine a basket of stocks that represents a particular segment of the market, like the S&P 500. An index fund simply tracks that basket, meaning you're buying a tiny piece of all those companies. Collins argues that for most investors, trying to pick individual stocks or beat the market is a fool's errand. Index funds offer broad diversification, which helps spread your risk.
So instead of trying to time the market or pick winners, you're essentially betting on the overall growth of the economy. Sounds pretty passive, which might appeal to people who don't want to spend hours researching individual companies.
Exactly. And another big advantage of index funds is their low fees. Actively managed funds, where someone is actively choosing stocks, tend to have much higher fees, which can eat into your returns over time. Collins is a big believer in keeping costs low to maximize your long-term gains.
Lower fees, diversification, and a passive approach. Starting to sound like a pretty compelling strategy. But doesn't this go against the advice we often hear about diversifying across different asset classes, like bonds and real estate?
Collins acknowledges the importance of diversification, but he simplifies things by focusing primarily on stocks for long-term growth. He argues that, over time, stocks have historically outperformed other asset classes. He does suggest adding bonds to the mix as you get closer to retirement, to reduce risk.
So it's not an all-or-nothing approach. But he definitely seems to favor a stock-heavy portfolio for younger investors who have a longer time horizon. That makes sense, given the higher growth potential of stocks. But what about those who are nearing retirement or already retired? What does he suggest for them?
Collins addresses that as well. He introduces the concept of the 4% rule, a guideline for withdrawing money from your investments in retirement. It suggests that you can safely withdraw 4% of your portfolio balance each year without running out of money. Of course, individual circumstances and market conditions may warrant adjustments, but it's a starting point.
That's a helpful rule of thumb, especially for those transitioning into retirement and figuring out how to manage their nest egg. But let's shift gears a bit and talk about something Collins is quite passionate about, his dislike of financial advisors. Why is he so skeptical of the industry?
He argues that many advisors prioritize their own profits over their clients' best interests, often pushing products with high fees that eat into your returns. He believes that by the time you know enough to pick a good advisor, you already have the knowledge to manage your own money.
So it's not that all advisors are bad, but he's urging us to be cautious and do our research before entrusting someone else with our hard-earned savings. It's about taking ownership of your financial decisions.
Exactly. He wants people to feel empowered to manage their own finances. And he provides the tools and knowledge to do so. Now, I know we focused a lot on the practical aspects of investing, but Collins also delves into the psychological side of money.
Right, like his concept of FU money, which is about more than just the numbers. It's about the freedom and choices that come with financial security. But there's also a deeper message in his book, right? It's not just about accumulating wealth. It's about what that wealth allows you to do.
Absolutely. He talks about aligning your money with your values. And one way he suggests doing that is through philanthropy. He dedicates a whole chapter to how to give like a billionaire, emphasizing that you don't need to be wealthy to make a difference.
That's a powerful concept. It's about using your resources, however big or small, to support causes you believe in. So it's not just about FU money, it's about FU money with a purpose.
Exactly. And that brings us back to the core message of the book. Financial freedom is attainable for anyone willing to put in the effort. It's about making conscious choices,
Yeah.
being disciplined, and staying focused on your long-term goals.
So it's not a get-rich-quick scheme, but a roadmap for a more intentional and fulfilling life. We've covered a lot of ground, from the mechanics of index funds to the psychology of investing and the importance of aligning your money with your values. What other nuggets of wisdom does Collins offer in the later chapters?
Well, there's so much more to explore. He delves into the nuances of asset allocation, discusses the role of luck in investing, and provides guidance on navigating market crashes with a level head. He even shares personal anecdotes and lessons learned from his own financial journey.
It sounds like there's a lot to unpack, and I'm eager to dive deeper into those insights, but for now, I think we've given our listener a solid understanding of Collins's core principles and the simple path he lays out for achieving financial freedom. Welcome back to the deep dive. We've spent the last two parts exploring kind of the foundational principles of the simple path to wealth. We've talked index funds, FU money, even the perils of financial advisors. But there's some deeper layers to Collins' philosophy that I'm really curious to unpack. What stood out to you in those later chapters?
Well, one thing that struck me was Colin's honesty about the role of luck in investing. He doesn't shy away from acknowledging that. Sometimes, despite our best efforts, external factors can influence outcomes.
Right. It's like that saying, you make your own luck, but there's always a degree of chance involved. Does he dismiss the importance of like skill and strategy altogether?
Not at all. He emphasizes that, well, we can't control everything. We can control our reactions and decisions. Having a sound investment plan, staying disciplined, and not letting emotions drive our choices, these things can help mitigate the impact of luck.
So it's about taking ownership of what we can control and not getting discouraged by the things we can't. It's a mindset shift, isn't it?
Precisely. And this ties into another important concept Collins explores, the emotional aspect of investing. We've touched on the fear that can arise during market downturns, but he also addresses the dangers of greed and the temptation to chase quick profits.
It's like he's saying that our emotions can be our worst enemy when it comes to investing. We get caught up in the hype, make impulsive decisions, and end up undermining our long-term goals.
Exactly. Collins advocates for a calm, rational approach, one that's grounded in a solid understanding of market cycles and a commitment to long-term growth. He stresses the importance of having an investment plan and sticking to it, even when your emotions are telling you to do something else.
Easier said than done, right? I mean, we're human, not robots. How does he suggest we navigate those emotional waves, especially during turbulent times?
He offers some really practical advice. One thing he suggests is having a financial emergency fund, a cushion of cash that can cover unexpected expenses, so you don't have to dip into your investments when things get rough.
That makes a lot of sense. It's like having a safety net. That allows you to ride out the storms without making rash decisions.
Exactly. He also encourages people to focus on what they can control, their savings rate, their investment choices, their spending habits, and to tune out the noise of the market.
It's about staying focused on your own journey, not getting caught up in comparing yourself to others or trying to time the market.
Precisely. And he emphasizes the importance of finding a supportive community, whether it's friends, family, or online forums, where you can share your experiences and learn from others who are on a similar path.
It's like he's saying that financial freedom is not a solo sport. Having a support system can make all the difference, especially when facing challenges.
Absolutely. And I think that's one of the most valuable takeaways from the simple path to wealth. It's not just about the numbers. It's about the mindset, the habits, and the community that supports your journey.
We've talked a lot about Collins' investment philosophy, but he also delves into some specific strategies for building wealth. Can you share some highlights?
Well, he dedicates a significant portion of the book to explaining the power of compounding, which he refers to as the eighth wonder of the world. He emphasizes the importance of starting to invest early and letting your money grow over time.
It's like planting a seed and letting it grow into a mighty oak tree. The earlier you plant, the more time it has to flourish.
Exactly. And he provides compelling examples of how even small amounts invested consistently over time can accumulate significant wealth. He encourages readers to think of investing as a marathon, not a sprint.
So patience and persistence are key. It's not about chasing quick returns, but about building a solid foundation for long-term financial security.
Precisely. And he provides practical guidance on how to calculate your savings rate, choose the right investments, and manage your portfolio over time. He even offers suggestions for how to allocate your assets based on your risk tolerance and time horizon.
Sounds like he's equipping readers with a comprehensive toolkit for navigating the complexities of the financial world. But he also seems to be challenging some conventional wisdom, like his critique of dollar cost averaging. Can you explain his stance on that?
Collins believes that statistically speaking, it's more beneficial to invest a lump sum when you have the funds available, rather than spreading it out over time through dollar cost averaging.
Yeah.
He argues that this allows your money more time to grow and benefit from compounding.
So it's about overcoming the fear of investing all at once and trusting the long-term upward trend of the market.
Exactly, and he backs up his argument with historical data and analysis, showing that in most cases, lump sum investing has outperformed dollar cost averaging. Of course, individual circumstances may vary, but it's a thought-provoking perspective. That challenges a widely held belief.
It's a reminder that there's no one-size-fits-all approach to investing. What works for one person may not work for another. And it's important to do your research and find a strategy that aligns with your goals and risk tolerance.
Absolutely. And that brings us back to the importance of financial literacy, which Collins emphasizes throughout the book. He wants readers to feel empowered to make informed decisions about their money, not simply rely on the advice of others.
So it's not just about following a set of rules, it's about understanding the principles behind them and adapting them to your own unique situation.
Exactly. And he provides a wealth of resources and tools in his book to help readers develop their financial knowledge and skills. He even includes a glossary of terms and a list of recommended reading for those who want to delve deeper into specific topics.
It's like he's handing you the keys to the financial kingdom and encouraging you to explore it on your own terms.
Precisely. And I think that's what makes the simple path to wealth so compelling. It's not just a guide to investing, it's a journey of self-discovery and empowerment.
Well, we've reached the end of our deep dive into the simple path to wealth. It's been an insightful exploration of J.L. Collins' unique approach to personal finance and investing. What are your final thoughts?
Overall, I think the simple path to wealth is a valuable resource for anyone who's looking to simplify their finances, build long-term wealth, and achieve financial freedom. Collins' writing is clear, engaging, and refreshingly free of jargon, making it accessible to readers of all levels of financial literacy.
I couldn't agree more. He manages to break down complex concepts into easy-to-understand language, while still providing actionable advice that readers can implement in their own lives. His emphasis on the psychological aspects of investing, the importance of emotional discipline, and the role of luck makes this book stand out from the crowd. It's not just about the numbers, it's about understanding the human element of money.
Absolutely. And what really resonated with me is his emphasis on aligning your money with your values. It's not just about accumulating wealth. It's about using your resources to create a life of purpose and meaning.
And for our listener, I hope this deep dive has sparked a sense of curiosity and empowerment. Financial freedom is attainable, but it requires a shift in mindset, a commitment to lifelong learning, and a willingness to take ownership of your financial journey.
Well said. The simple path to wealth provides a roadmap, but ultimately it's up to each individual to take those first steps and create their own path to financial independence.
Thank you for joining us on this deep dive. We hope you found it insightful, engaging, and empowering. Until next time, keep learning, keep growing, and keep diving deep.